Hi everyone, welcome back to Raveling Money. Today's topic is a key one if you really want to understand your money. We're going to speak about credit scores, what they are, why they matter, and how they can affect your money. If you've ever wondered why your credit score is so essential or why you couldn't get a loan, stay here. This is for you. What is a credit score? Let's get down to business. A 3-digit number called your credit score shows how likely you are to pay back money you borrow. Your credit score tells lenders, such banks and credit card companies, whether or not to provide you credit and what interest rates to charge you. Your score is based on things like how long you've had credit, how much debt you have, and how well you've paid your bills. Your score can be anything from 300 to 850. Depending on where you live. For example, poor score can be 300 to 579. Fair score can be between 580 to 669. Good score can be between 670 to 739. Excellent score could be anywhere between 740 to 850, and these are the ranges for credit scores. So, lenders will trust you more if your score is higher. Like a report card for your money, the better your grades, the more chances you get. What does your credit score mean? Now, you might be wondering, why does this number mean so much? Your credit score is very important for your finances, especially when you want to borrow money. It has an effect on things like securing loans, mortgages, or even renting an apartment. For instance, you might want to buy a car. If you have a good credit score, you'll get accepted quickly. The best part, your interest rate will be lower. But if your credit score is low, you can have trouble being accepted, or end up with a considerably higher interest rate, which means you'll pay more for the same loan. The individual with strong credit receives a loan with a low interest rate, and the person with terrible credit gets a loan with a high interest rate. In simple terms, having a good credit score implies you pay less to borrow money. A nasty one? Well, you pay more. What makes your credit score go down? Okay, so what makes your credit score go up or down? There are 5 key things that can help you raise or keep your score. Number 1. 35% of your credit score is based on history of payments. This is the most important thing. It's a big benefit if you pay your payments on time. It's very important to keep track of due dates because late payments might lower your score. Number 2. 30% of your credit score is based on how much credit you use. This is the amount of credit you have compared to the amount of credit you can use. If you have a credit limit of $5,000 and you use $2,500, your credit utilization is 50%. You should try to maintain it below 30%. The lower, the better. Number 3. 15% of your credit score is based on length of credit history. The longer you've had credit, the better. Lenders want to know that you have been using credit properly for a long period. Number 4. 10% of your credit score is based on credit types used. Having a mix of credit types such as credit cards, car loans, and mortgages can help your score. But don't register accounts merely to make this better. Only open new credit if you really need it. Number 5. 10% of your credit score is based on new credit. Every time you apply for credit, your score may go down a little bit. So only get new credit when you really need it. These 5 things together make up your score. So keep an eye on them and try to make each one better over time. Example from real life. Let's make this a real life example. Say hello to Jane and John. Jane's credit score of 750 is very good. She pays her bills on time, doesn't use too much credit, and has a good mix of credit. She may receive a car loan with a 3% interest rate because her score is so excellent. She buys a car for $20,000 and will pay about $1,500 in interest over the term of the loan. Now say hello to John. 580 is a fair credit score. John has skipped a few payments in the past and has used up most of his credit. He gets authorized for a car loan, but the interest rate is 10%. He pays $5,000 in interest on the same $20,000 loan, which is more than 3 times what Jane would pay. Do you see the difference? A good credit score not only helps you get accepted, but it also saves you money in the long term. How to make your credit score better. If you want to raise your credit score, here's how to accomplish it. Step 1. Make sure to pay your payments on schedule. Set up automatic payments for your bills if you can. This way, you'll never miss a due date. Step 2. Don't use too much of your credit. Don't use more than 30% of your available credit. If you're using too much, try paying off your bill faster or asking for a bigger credit limit. Step 3. Look at your credit report. Get your free credit report once a year to make sure there are no mistakes or fake accounts that could hurt your score. You can access it from sites like annualcreditreport.com. Step 4. Don't open too many new accounts. Every time you apply for credit, your score may go down a little. Only open new accounts when you really need them. Myths about credit scores. Before we finish, let's clear up some common misunderstandings about credit scores. Myth number 1. Looking at your credit score will hurt it. Not true. A soft inquiry is when you check your own credit score, and it doesn't change your score at all. Myth number 2. Closing credit cards will make your score better. Closing a credit card can actually affect your score. It lowers the amount of credit you have and can raise your credit utilization ratio. Myth number 3. To develop credit, you need to keep a balance on your credit card. That's not true. Paying down your amount in full every month will help you develop credit. That's all there is to it. To be in control of your money, you need to know what your credit score is. A good score gives you access to better loans, lower interest rates, and more ways to make money. You can raise your score over time by keeping up with your payments, maintaining your credit, and avoiding frequent mistakes. Don't forget that it takes time to build a good credit score, but you can do it with some patience and smart money management. If this video helped you, please give it a thumbs up, share it with someone who could use the information, and leave a comment below if you have any questions about credit scores or want to share your tips for improving them. And don't forget to subscribe to get more videos about personal finance. See you next time.